Welcome to my series called Trading ABCs. Every day from A to Z, I'm going to give you a trading term and explain it in 5 sentences or less. So let's start today with the letter A. Accumulation. What is accumulation? This is when smart money is quietly building a position before the real move happens. Price moving sideways and it's just really boring to watch. Like nothing's happening. We're chopping around. Retail traders get really impatient during the accumulation phase, but this accumulation phase usually happens before a really strong trend breaks out. Boring charts in time turn into powerful charts. B, break of structure. This happens when price clearly breaks a previous high or a previous low in trend direction. It gives you a little hint that momentum may in fact be shifting. Not every break means that the trend is going to break. You need to take all the context of what's going on in the charts into consideration. Strong breaks usually close decisively. Beyond structure, wicks alone are not enough. If it's a wick closing, it's probably a liquidity sweep, not a true break of structure. B, confirmation. Confirmation is proof that your trade setup is valid. It usually comes after a signal to show that the move may indeed go in your favor. For example, you guys, a candle closing above resistance, confirming that we have a breakout. It's one clear reason to enter, not a collection of reasons like confluence. I know they kind of sound the same, but they are different. You can think of it as the market saying, yes, this trade is real. We've got our confirmation. Now let's see if the probability plays out. E, drawdown. This is the amount that your account drops from its peak. It's basically showing on paper how much money you've lost. Drawdown is 100% normal in trading because you will lose trades. It is a part of the game. The key is managing it so it doesn't become catastrophic to your account. You can only speculate on the market if you have the capital to do so. Think of this as the market testing your risk management and your discipline. E, entry. This is where you're getting into your trade. Good entries align with market structure, confirmation, and risk management. Chasing a trade usually leads to regret. This is why we wait for our setup and the precision to enter, because the precision of your entry matters. F, flush. A flush is a strong and aggressive move, usually toward the downside. Price drops hard and emotional traders usually panic. It often happens after the liquidity is taken from the high and price violently reverses and flushes out. Weak longs. Volume spikes, candles expand, and there is very little to no pullback. Flushes aren't random. They're usually engineered to clear out one side of the market to allow for the real move to happen. Remember, your opportunity is not in chasing the flush. It's in waiting for the reaction after the move exhausts itself. The golden cross. This is when a shorter moving average crosses over a larger moving average. For example, the 50 crosses over the 200. This signals potential bullish momentum. Remember, all indicators are lagging, right? So you still have to take your context into consideration. H, high of day. This is the highest price reached during a specific trading session. Remember, there are multiple trading sessions. There's an Asia session, a London session, a New York session. Okay, so it's the highest of that particular session. Intraday traders watch this high of day very, very closely because it can signal a couple things. Breaks above high of day can trigger momentum, and rejections of high of day can lead to pullbacks. Keep in mind, a high of day is a magnet for liquidity. I, imbalance. In trading, an imbalance happens when buying or selling pressure is so strong that the direction moves with a fierce momentum and very little opposition from the other side. This strong move often leaves a gap on the opposite side, and it makes an inefficiency in the market. Traders keep a close eye on these zones because price often revisits them. These imbalances can signal super strong momentum. They can also signal potential areas for re-entry into the move. J, journal. This is your trading diary. This is a necessity. You need a trading journal. What a trading journal does is it tracks entries, exits, emotions, mistakes. Patterns show up when you document them. This is the best, fastest way to grow as a trader and refine yourself and refine your process. Feelings lie, your data does not. Serious traders journal. I personally use TradeZilla to track and review my trades. It just keeps everything organized in one place. I love all the data markers that they have. If you're curious about the TradeZilla trading journal, you guys can check out the link in my bio. Okay, key level. A key level is a price area on the chart where the market has reacted before. It's usually a previous high, low, support, or resistance zone. Price tends to respect these areas because that is an area where buyers or sellers are stepping in. It's all about waiting for these zones. This is what they talk about when they say don't chase your trades. It means waiting for price to come to one of your key level zones and then taking a trade from there. You don't trade in the middle of your key area zones. That is the chalk. Liquidity. Liquidity is where orders are sitting in the market. Usually the liquidity is resting above highs and below lows. How far the liquidity can sweep up or sweep down is unknown, but it goes up and grabs those orders, takes you out, fills them up, and then reverses. This is usually where traders are placing their stop losses or their breakout entry. So if you've ever had your stop loss hit only for it to reverse in your direction, you were the liquidity. Remember, follow the liquidity, don't be the liquidity. Easier said than done, I know. M, market order. This is an order executed at the current price, not the best price, but it guarantees execution. So a market order is great to use when you're trying to get in and out of a trade quickly. There is another thing called a limit order, and that's where you're getting the best price, but you're not guaranteed to get filled. And news. Economic releases that move the markets extremely fast. And in today's political world, it could literally be a tweet from our president, but it can also be earnings reports, all that kind of stuff. These releases can create volatility spikes. The spreads can widen on the charts. Basically, if you don't have a plan around the news, stay out of the markets. News can 100% ignore your technicals. Opening range. Opening range is the high and the low formed within the first set period of market open. It's usually the first 5 to 30 minutes. Many traders use this to gauge early momentum. Breakouts above or below this range can signal potential direction. And you've probably heard people use this as part of their strategy called the orb strategy. And there's many different strategies around this. P, price action. This is the study of how price moves. In my personal opinion, price is king. When you know how to read price, you do not have to rely heavily on indicators. Traders are reading price by candles, by market structure, by momentum. There is an art to reading the chart. And I would have to argue as a new trader, learning how to read price action is probably one of the hardest things to master. Many believe that price action reflects raw market psychology. Q, quality setup. A quality setup is a trade that checks all your rules, but it goes deeper than that. Trend alignment, clear structure, confirmation, proper risk to reward. But there is a crucial part of the quality trade setup that I think a lot of traders don't think about. And that is also being in a quality state, which means your emotions are on point for the trade as well. You're thinking clear. It's aligning both market structure with mental structure. So get your mind right and get your move right. R, risk management. These These are the rules you follow to protect your capital. It is all about capital preservation. All you are doing in the market is speculating how much you're willing to give the market if you are indeed wrong on your speculation. The whole point of trading is to make more money than you risk. That's it. It's so simple, yet it is so hard because our egos are so big and we don't want to be wrong. Well, too bad. You're going to be wrong time and time again, over and over and over again. So make it a small wrong, not a big wrong. It's all about position sizing, stop losses, daily stop losses. Need to have all those parameters in check as a trader so we don't go over budget. Something I've always been adamant about is you have to be okay taking a small loss with discipline, or else you're going to take a huge loss with your emotions. Yes, scalping. Scalping is a fast-paced trading strategy that's focused on small price movements. Scalpers are usually in and out within, just a few minutes, and precision really matters as a scalper. Scalpers rely on tight risk management, quick execution, and high probability setups rather than large trend moves. I personally love a quick scalp, especially in the volatility of the futures markets. T, time frame. This is the interval a trader uses to analyze price movement. This could be the 1 minute, the 5 minute, the hour, the weekly, the daily. Time frame determines how much data your candle represents. Your time frame directly affects your trade duration and your decision-making speed. Lower time frames like the 1 and the 5 minute are great for intraday traders, for scalpers usually, while higher time frames like the 4 hour, the daily are loved by swing traders. Strong traders are going to align multiple time frames together, using higher time frames to find the overall direction in the market and a lower time frame for precise entries. There is no perfect time frame, and remember, using one is so specific to who you are as a trader, your trade style. Uptrend. And you're going to want to stay till the end because I have a practical tip for you if you're a new trader on how to get in on the uptrend. So what it is price consistently making higher highs and higher lows. This shows that buyers are in control, but also that there's a sustained demand over time, not just one strong candle. Remember that structure matters more than speed. In an uptrend too, you're going to want to look into what a reversal is versus what a healthy pullback is. All right, the practical advice, I promise. Us as new traders usually buy the top of an uptrend because we see a really strong candle and push and try to buy the breakout. But there is a higher probability approach if you wait for the pullback into structure and you wait for buyers to step back in and push it back up. Remember, participate in the continuation. Stop trying to predict the top. V, volatility. This is the speed and magnitude at which price moves in the market. High volatility means price is moving quickly and it's covering a large range, whereas low volatility means that price is moving slower and it's staying within a tighter range. Volatility is not bearish or bullish either, just so you know, because I didn't know this as a new trader. It's literally just the measurement of the move. And although volatility is scary and sometimes as a new trader it's like too much, you have to realize that there has to be volatility in the market in order for profit to exist, because if the charts aren't moving, we're not filling orders. W, whipsaw. Whipsaw happens when price suddenly moves one direction and then quickly reverses in the other. This traps the trader on the wrong side of the trade. It often occurs in choppy or low volume markets. Traders might enter thinking a breakout is happening, only for price to snap back, hence whipsaw. Risk management and waiting for confirmation can avoid the chop, the whipsaw. X, execution. Okay, I know that's a little bit of a cheat, but X was a really hard one, okay? Execution in day trading is entering and exiting the position in the market exactly as you planned. It goes beyond just getting your order filled. It's getting filled at the price and speed that your strategy requires. High quality execution minimizes slippage, and it also ensures that your trade aligns with the proper risk and profit targets. In short, execution is the bridge between your analysis and real profit and loss. Y, yield. yield. Yield is basically the profit or the return you earn on an investment. For stocks, this is usually the dividends you get versus the stock price. And in the futures market, short-term trading in general, yield isn't about dividends. It's more like how much is your trade making you versus how much are you risking. Yield helps you compare different trades or investments in the market quickly. Think of it like a little speedometer for your money. Basically just telling you how fast is my money growing versus how much I put in. Zoom out. When a trader is telling you to zoom out, you have to look at a higher time frame chart. If you're feeling discombobulated on a smaller time frame with smaller candles and it feels noisy, go up in the time frame. You get a clearer trend and a clearer picture of what's going on at the higher times. That concludes our Trading ABC series, you guys. I will see you in a couple days for a brand new series that I'm really excited about. I hope you enjoyed this one.